Hello and welcome to Property Mastermind Podcast, episode 140. Today, how to understand profit in property development. Great episode. You're going to learn a lot and find this very useful. Let's jump on into episode 140. Hello, welcome to episode 140. I think I did my intro different. I usually go, hello. So hello, everyone. Hey, I've got the amazing Bob Anderson beside me, who is a legend when it comes to property development. Good morning, Bob.
Hello, Hillary.
Good morning, Bob. How
Good
are you?
morning.
Oh, good. Are you good?
I'm good. It's bright early hour.
And well, it's not too early,
No.
but we did come in a little bit earlier to do it. And this is take 3 on the intro because my tongue got all tongue-tied. I couldn't get the words out.
It's called fat tongue syndrome.
You reckon?
I get it sometimes.
Oh my goodness. I was like, I think I need more coffee.
Could be it.
It could be it. Anyway, Bob, how to understand profit and property development is today's topic. And it's a great topic. But before we dive into that, what's your tip for the day?
My tip for the day is never judge a person's net wealth by the car they drive. I've got some good examples of that. People I've met. There's a whole book devoted to that.
Yeah. Have you read the book?
The Millionaire Next Door. Yeah. It's been around for God knows how long. But I made that mistake once. There was a guy driving around in this crappy old Mazda that was rusty, and I won't tell the long story version of it. But a mate was going to introduce me to somebody, and I met this guy. He had this old ute. I thought he was a groundsman. Turned out he's worth 200 million net, and this is like 20 years ago. When it's probably 400 million net now. His brother was even wealthier.
Oh, my goodness.
And he used to kick around this old ute and pair of thongs and some old khaki shorts, and had some teeth missing.
Oh, so you never did that again?
No, but I've seen plenty of examples of that.
Yes.
A lot of fancy cars are owned by the bank.
Oh, yeah. You're seeing it the other way. Yes, I hear you. Yes.
Anyway, there you go.
Great example. Can I just ask you about the book, Bob? Have you read it? The
Millionaire Next Door?
Yes.
Or your book?
No.
Not 3 ones in. I've read it 20 times.
Yeah, I know.
Yeah, I have, yeah. It's American, but
good message.
These psychologists did an analysis over a long period of time of genuinely wealthy people and the sorts of cars they drive, and they're not always the sort of cars you think they drive.
Oh, well, there you go. I haven't read that book. I think I will. While we're on books, let's give ours away.
Hey.
The Secrets of Property Millionaires Exposed. Going to Katrina Girl. Katrina! We had coffee with Katrina on the weekend. I hope it all went well up near your development. And this is in the post to you. And for those of you who want a copy of 3 Wines In, jump over to hillarysaxton.com and grab yourself a copy.
And what's that going to do for you?
It's going to increase their self-confidence so they take action. So if you're lacking... If you're lacking the action taking in your life in any arena, that's the book you want to read.
That's a prerequisite for being a property developer.
Definitely.
There's a confidence game.
But also, I do have a podcast, Bounce Back Better. I'm going to put the link below. Jump on that if you're interested in a little bit of daily motivation or weekly. But anyway, Bob, enough about me, you, books, and the Millionaire Next Door.
Okay.
Let's jump into today's topic. And I will... So the topic is how to understand profit in property development. And I've got an email here I'm going to read. This was inspired just this morning over our morning coffee, because Bob and I get up nice and early. We sit on the balcony and have coffee and we just chat about whatever. And I happened to see an email because I did check my phone, but I had been up for a while. It wasn't the first thing I did. But I often do when I've put an investment email out. And so I get excited about, who's going to respond to it. So I might have a little sneak preview of what's going on. But anyway, somebody responded to it with a great question. And I said to Bob, if somebody's asking that question, then there will be a lot of people wondering about it potentially. So the email I sent out, I'm going to read the entire email.
Okay.
Or I'll skim through some of it, but I'll read the nuts and bolts that you need to know. And in everybody's defense, I probably could have written it a little bit more clear. We thought maybe I could take some of the blame here. It does make sense.
Well, I proofread it, so I'll take the other half.
Yeah, you double checked. But anyway, this was the email that went out last night. And normally we just send a Friday email, but sometimes we might send one because there's something else happening, and this was the something else happening. So, hi, whoever you are, commercial development, typically consists of commercial, offices in brackets, industrial, huge variety, and retail shops. I reckon about 1/3 of my 1.3 billion of development has been in the commercial sector. So yes, I wrote it for Bob actually. Well, there was a joint effort there. But anyway, nationally, industrial is hot and never more so than in southeast Queensland. It's going to remain that way for the foreseeable future. I'm not talking about ugly old sheds, but high-tech office showrooms of varying sizes. Well-located land is extremely short in supply. Plus, it does take specialist research and knowledge, and you might not have it if you've been restricting yourself to the residential sector. Then it says, also, profit margins are considerably higher. So here comes really the offer that I put out.
Okay.
We opened a cracker deal in southeast Queensland, 25% plus ROC, which means return on cost. We are opening up to investors in equity position. This means that you're part of the development and on the title. To qualify for a conversation and receive more details about the project, you need to have 1, a minimum of 200,000. 2, be ready to go. 3, be up for a 24-month term development. 4, be genuinely interested. If you tick these boxes, then hit reply and email us and supply your email address and phone number. So that was what I sent out last night, 6 p.m. Queensland time. Okay, now the response I got back, and I'll just read it off my phone, and this is the confusion. It didn't say, Dear Hillary. It just said, is it? It was a little bit assertive, but that's okay. Well, sort of. Is it 25? You've got to remember that you're actually emailing somebody as well, so it's polite, I suppose we could ask for. But is it 25% return on investment over 2 years? 12.5% per year? Please confirm. So that's the reply that we got. And I said to Bob after reading that, I said, the confusion to me looks like he thinks that it's an interest rate return, and that's okay. So, Bob, can you explain how he saw that and what it means? Because I think that there are a lot of people that might not understand ROC or like return on cost and all of that stuff.
I think property's got the biggest number of acronyms, hasn't it? You know, when you think about it, you could write a whole dictionary on them. ROC, that's what we put in the email. Return on cost. So for those that aren't familiar, it's a typical benchmark, probably the most important benchmark that we use when we're analysing a property development to see if it's profitable and if we're likely to get finance. Pretty important. So return on cost is the profit that you make as a percentage of your total costs. So pretty simple. If your total costs were $1 million and your profit was 200,000, that's a 20% return on cost. 200,000 as a percentage of $1 million. And, you know, different projects require different percentages ROC. So that's what we meant. And, you know, maybe the mistake was in assuming everybody would understand the term ROC 25% plus. Now, remember that this email went out to our database. So these people generally in our database are interested in property development.
At different levels. So some people are absolute beginners and some people are developing full-time or have developed a lot. I had a man ring yesterday and he's done over 50 million. And I was like, wow, how awesome is that?
Yeah.
Bob, you just did say something that I think it needed clarifying in that. Could you repeat it? And I'll just interrupt with my clarification, with my...
Repeat what, the numbers?
No. Oh, yeah, maybe. Oh, I've forgotten
Return on cost. So it's the profit as a percentage of your total cost.
Yes, and I think even last week or this week, there was a conversation around the profit. That's the money after you've received back what you put in. Because somebody got confused about that recently as well.
In simple terms, it's your sales less all your costs equals your profit. Same in any business, really, not just property development. So that ROC, return on cost, is a number that has significance. First of all, it talks about the profitability of a project. Like if you were looking at, say, doing 3 townhouses and your ROC was 5%, it's way too low to do. It's too risky and you'd never get finance on it anyway, because the financier might be looking for a number somewhere between 15 and 20%, let's say, depending on the financier. So it's an important number for finance and for understand profitability. I think hear that the person that wrote the email, in their mind, they're thinking more like an investor than a developer. So if somebody said to me, I'm doing a property development, the ROC is 18%, I know, bingo, oh, okay. What sort of project is it? Yeah, great. Okay, good on you. Sounds good. Hope it goes well. But if we're talking about ROI, that's return on investment. It's more of an investment acronym than it is a property development one.
Yeah.
I mean, the obvious simple example is ROI. If you put $100,000 in the bank and you're getting 4% interest, the return on investment is 4% per annum. Pretty simple stuff. With property development, it's a bit different. So I've explained the ROC, which we're all familiar with.
Yeah.
But then there's another thing that we don't look at as much, and it's called return on equity. And that's getting closer to return on investment. So equity is the money that we put in to a project first before the financier puts in theirs. So simple example might be, take it back to that simple example. If our total costs were $1 million and we put in 200,000 equity and the financier lent us 800,000, our equity is 200,000. It's the money we have to put in up front before the financier puts in theirs. And of course, the financier puts in most of the money, which is a good thing. But that's what we call our equity. It's the cash, it's the money. It doesn't have to be cash necessarily. It could be another property, but that's making it a bit more complex. It's the cash we put in to a project so that we can get the finance. So return on equity, that's slightly different. It's, as I said, it's moving more towards return on investment. And you can calculate that. In fact, a lot of the programs, feasibility programs, calculate return on equity. It's not a big one we look at as a developer, but we always look at it to see what it is. An investor might look at it more. So return on equity, it varies in time though, that's the thing.
Yeah, I was just going to bring that up because this morning when we were chatting about it, you said another thing that people get confused on is because this actually has a 50% return on cost, but that's over 2 years, which brings it back to 25% per annum.
Oh, it's 50% return on equity.
Oh, sorry, but that's what we were talking about this morning. So people don't often factor in the time component. And you said often you see deals put up and it might say it's got a 30%, what's going to have 30%?
Return on investment or return on funds or
yes, but when you
capital
and like do annualize that, then it's not. It actually comes back to 15%, and that's what people don't really understand. Could you explain that better than I?
That's a good tip.
There's a good tip.
So here's the tip that Hilary alluded to, and I often see it when developers are looking for investors to come into a project, and you see the term, like, to use your numbers, 30% return on money, 30% return on capital funds, call it whatever you like, investment. And people think, oh, gee, 30% return, that's pretty good. I'm only getting 4% in the bank. But is that 30% annualized? Like if you're saying you're getting 4% at the bank, what you really mean is you're getting 4% per annum
on your
at
money.
the bank.
Yeah.
But that's not what we just talked about. We talked about a 30% return on funds.
Funds.
Is that annualized? And that's what tricks up some people. It's a mistake some people make when they're looking for an investor in what they say or write sometimes. It's also investor makes the mistake. If it was a 30% return on funds, but it was a 2-year project, like your money's out for 2 years,
then it's 15.
Then it's roughly 15. If it was compounded slightly, but it's about 15% per annum, let's say. That's quite different. Now you're comparing 15 to 4% at the bank, not 30. If it was a 3-year project,
we're down to 10.
We're down to 10.
Yeah. So, Bob, we've got here, just so you've got 25% ROC.
Yeah.
So we're talking annually. Do you, rule of thumb, always speak annually? Is that how you do it? Or is that how it's supposed to be?
Not when I'm talking about ROC, because that's got nothing to do with time.
Right.
So return on cost is very simply the profit as a percentage of your total cost. It doesn't take into account the length of the project.
Right.
There's other things that can,
Ooh.
things like
I was going to say
IRR,
IRR. I knew you were going
internal
there.
rate of return.
Because that's the cost of your money, how much money costs, isn't it?
It takes, to keep it simple, it takes time into the equation. Look, if you're doing a simple project that's going to take, up to 2.5, maybe even up to 3 years, return on cost is a reasonable benchmark that the financiers use. I've been involved in some really big projects, like when I worked for some of the big development companies. One of the projects that I managed for a big development company was a 67-story high-rise office block in the city, and it's a 5-year project. So the return on cost isn't all that relevant because of the amount of time that's involved. Things like the internal rate of return or the annualised return on equity, which is different again, that's more relevant because over a longer period of time means more.
Yes.
You do a little, like you could do a little 2-lot subdivision, a splitter where you don't even need a development permit. You could punch one out in a few months. And, even if you made, pick a figure, say you made $100,000 on a splitter. But if you did it in 3 or 4 months, that's a pretty good annualised return.
Yeah.
You've made $100,000 in 4 months. If you annualise that, it's 300% return. But you just want to be doing a few of them. So, yeah, it can be a bit weird when you start either introducing or not introducing annualised. But back to this, potentially the mistake we made is we use the acronym ROC, return on cost. And unless you understand property development, ROC might not have meant much.
Yeah.
And so in this case,
how should I have written that?
Well, maybe we should have put ROC in brackets return on cost, but it's just that most of the people who received that email a majority would understand it and some wouldn't. So, but remember that email that you sent out was really just had the very bare bones in it.
Oh, yeah.
We didn't say much about it because we just want people to think, oh, I could be interested in that, and then contact you. And then you could talk more about it, more about them, sort of investment that they're really looking for. And if the upshot of that was this project could be a good one for them, then you'd release the information memorandum to them, which has got all the information.
Yeah.
So you've got to look at what was the purpose of the email. It wasn't to have every little thing in there or you'd end up with a 30-page IM.
Yeah, exactly. And in my defence, I think we're opening up to investors, and we're opening up to investors in equity position. I thought that spelled it out a wee bit.
Yeah.
And that means you are part of the development and on the title. To me, that says a little bit more.
Yeah, it does.
But
once again, if it's somebody that's relatively new to our community, hasn't done our development course, hasn't done a development, their experience is limited to perhaps an investment property or whatever, then I can understand the confusion, perhaps.
Yeah.
But you just raised something there, and I just might expand a little bit on investors who invest in property developments. To keep it simple, there's 2 types. So we've got our own names for them, as we know.
Yeah.
So we've got what we call a loan partner. Now, a loan partner is an investor who loans money to a project, but they're not involved in the project at all. They're not on the title of the land. They've got nothing to do with the development finance. They simply loan money to the development.
Get an interest rate return.
And they get an interest rate return for that money.
And I actually sent out that email last Friday for looking for that exact thing and pretty much got one immediately. So So that is an interest rate return. We refer to that as a loan partner. It makes sense. They are loaning money.
And that's annualised. It's an interest rate. We always annualise it. We might say, well, I know you've just done a little one actually yesterday. Went out yesterday, a little one
90,000
first mortgage.
Yeah,
little 90,000 first mortgage.
It's helping someone
12%
out.
interest.
Yeah.
It's first mortgage. It's very safe. It's 12%. If it was a second mortgage, it might be 17%. And I know you did one last week like that.
Yeah.
And that's where people lend money to a development and get an interest rate return. So it's pretty, you could say the ROI is 17, we just say the interest in that case. The interest is 17% per annum, and your money is going to be out for 12 months or 18 months. So that's pretty straightforward. So that's a loan partner, interest rate return. The other type is what we call an equity partner, and that's where an investor is part of the project.
And so if you struggle remembering those two, you might think if you own a house, you have a certain amount of equity in it and you own that. So that might be a way you could remember you're
You're right.
owning.
It's got to do with ownership.
Yeah.
Yeah, that's the key word. So an equity partner, an investor would come into a project. They'd be usually on the ownership.
Can they sometimes not be on the ownership?
Well, they would probably want to be on the ownership. Otherwise, they end up really being a hybrid of in no man's land between an equity partner and a loan partner.
Have you seen that very much?
It's technically possible. It's also technically possible that they mightn't be on the loan, but what's going to happen is their profit share is going to be greatly diminished, that they might as well be a loan partner.
Right.
So with an equity partner, as I said, they're part of the ownership. They're part of the entity that owns it. Whether it was a company or a trust, they're part of that entity. And because they're part of the project, their reward is profit share, not an interest rate return. And so once again, that's different. That we call them an equity partner. So that particular email was about an opportunity to become an equity partner
Share
in the project.
Profit, yeah.
So you're not just sitting on the outside with a loan document and getting an interest rate on your money. You're actually in there for profit share. And part of the structure, part of the title, it's a unit trust type structure. So the investor would own units in the trust. That trust would own the land. It would do the development, and at the end, the profit would be shared. It come back through the trust to the unit holders.
So I'm just thinking already, Bob, for some people, even that's confusing. But a lot of people understand what that means. But if you're new to property development, that can be a little bit confusing.
So not understanding the difference between, let's say, the loan situation and the equity ownership situation, you could get confused.
I was talking about the units and stuff.
Yeah, well, that's just a type of structure. You have shares, companies have shares.
Yeah.
Unit trusts have units. So I think, back to the sort of core of this thing was the email. Return on cost, person wouldn't have understood what ROC was. Did the normal investor thing. What's my return on my money?
Yeah.
And that wasn't even mentioned because it's an equity thing. But you can work it out. I mean, for that project, the whole project I'm talking about,
yep.
Look, this is simply it. It's a 2-year project. You put 1.8 million worth of equity in, it makes 2 million profit. 1.8 is almost 2 million. So in 2 years, it makes probably 110% profit. So if you wanted to annualize the equity return on that project, it's probably about 55% per annum, just roughly on top of my head. And that's not what we call highly geared. That $1.8 million worth of equity is not the minimum amount you could put in there.
No, we just went for a comfortable amount.
You'd probably get by on about 1.4, but we'd like to be a bit conservative and have extra, buffer in there. In which case, the return would be even higher.
Yeah,
it wouldn't be. Yeah, it'd be higher again.
Could you just break down then? It's not highly geared for the people that don't understand that.
It's not highly geared. So we haven't put in the minimum amount of equity and the maximum amount of loan.
Yeah.
We've put in more than the minimum requirement for the equity, which gives us quite a healthy buffer.
And Bob, I'm gonna ask that question because people would say, well, why would you do that? Why would you want to have that healthy buffer? Why would you want to have that sitting
conservative?
Just being conservative.
And there's investors involved in this project that we're doing.
Right.
And we look after the investors. We make it as safe as we can. So yeah, we'll put more capital in than we need. We'll have a nice healthy buffer in there because there's investors involved,
right.
and it still gives a fantastic return even when we take a more conservative approach. Even the feasibility we do, where we analyse all the numbers, is conservative. And that's just the way we do it. As you know, when we're doing a project with investors, we take a fairly conservative approach.
Okay, so I hope we clarify that. I just found it really interesting, and I love when we get a question or somebody's asked me a question that I think, well, other people might be asking the same thing. And it's always good to just be a little bit brushed up on the ROIs and the IRRs and the ROCs,
ROCs
yes,
and the
all the
GRVs
and
we
the
didn't mention.
oh yeah, we didn't even go down that road today, but most people, well, we'll just get there anyway. If you are interested in learning more about industrial developments, because they are a little bit hot right now,
Yep.
there is demand, and there, Bob has said last week he's seen residential developments. Oh, he actually only said this in our live Q&A, which we have for our community, but we are seeing deals starting to stack up, which is great, and industrial is stacking up very well, as you can tell by the ROC on that conversation. So we're holding a free webinar next Thursday, isn't it? Next Thursday.
It is.
I'll put a link below to register, and there's a couple of things with it. I think we may charge $29 just so people who say they're coming will come.
It's very educational.
Yeah, it will be.
What you learn on is worth way more than that.
And it will be recorded as well. So if you wanted to register for it, and then you would get the recording afterwards to watch, it'll be available for a while. So if you're interested, there will be a link below. Also, if you are interested in learning more about development opportunities we have coming up, or investment opportunities that we have coming up, you're welcome to email in, or maybe this one interests you. What do you think, Bob? I think it might be close to full, but
I think it probably is, but we'll have another one.
Yeah, we do have something.
Getting on the ground floor of the next one.
Yeah, exactly. Jump on that ground floor. But anyway, that's about all from us today. How do you think, Bob? Well, we covered off and made things sound simple.
Well, I hope everybody understands. I've tried to break it down.
If you don't understand, you're welcome to send me an email, and maybe we could say it another way, because sometimes you hear things in one way that does not make sense to you. And I'm always reminded when I was learning to water ski, it took a female to say, Hillary, just do a pelvic tilt, where I had a man telling me to push my hips forward, and I couldn't work it out. When the female said pelvic tilt, I was like, oh, is that what you mean? So sometimes we have to hear things in a specific way to understand them. Anyway, I hope you found this useful, and we will. Anything else we need to tell everybody? No, that's it.
That's a good start.
It's a good start. Okay, well, maybe see you next week on our webinar. The link will be below. There will be an email going out about that, and feel free to reach out if you have any further questions. All right, bye for now.
Bye.
Bye.